So the big moves accompanying earnings releases are a major attraction for day and swing traders. To trade a stock which has released earnings takes a lot of skill and experience, and some traders find that challenging. But what most traders don't realize is that there's a way to make money with options that takes full advantage of the anticipated volatility of a stock leading up to earnings, where you can make some incredible returns in a trade that you enter and exit prior to the earnings being released. So the challenging part, dealing with the stock making a huge move right after the earnings release, is removed for the trader because he's out of the trade even before the earnings have been released. So if you're interested in the idea of making excellent returns on a stock approaching earnings, but you'll actually be out of the trade before the earnings are released, I think you'll want to watch this video, so stick around. Hi, I'm Seth Freuberg, and I'm the head trader of SMB Capital's options trading desk. SMB Capital is a proprietary trading firm located in Midtown Manhattan, and we provide capital for options and equity traders from all over the world, trading both remotely and in our offices here in New York City. Now, you'll want to click our subscribe button right now so that you don't miss any of our free trading videos produced for the trading and investment community. Now, in this video, we're going to be reviewing an option strategy known as the double calendar, which sophisticated options traders, like those on our trading desk here at our prop firm in Manhattan, employ because they understand the power of options and how they react to an impending large move in a stock, a move which almost always accompanies an earnings announcement. And while we're talking about option strategies, if you'd like to learn 3 more real-world option strategies that our traders use, including the surprisingly simple and powerful strategy that some of the greatest investors in the world, like Warren Buffett, use all the time, plus an options trading strategy that has a statistical 80% probability of profit month in and month out, plus an option strategy that you can employ with a stock that you like, where you'll make your target profit whether the stock goes up, goes nowhere, or even goes down a small percentage, then you should check out the free options class that we're currently running. So just go ahead and click the link that should be appearing now at the top right-hand corner of your screen. That will open the free registration page in a new window, so don't worry, you won't lose this video. You can also visit optionsclass.com to visit this free intensive workshop. It's an extremely rare opportunity for retail traders and investors to learn directly from Wall Street traders, but that's exactly what you'll be getting through this free online workshop. So go ahead, click the link to sign up now and don't miss it. Okay, so let's jump in. First of all, because some of you may not be familiar with how options work, we'll do a really quick review. If you know about options, don't worry, this will be quick, and then we'll jump into the guts of the lesson. So, a call option gives you the right to buy 100 shares of a stock at a certain price called the strike price by a certain date, which is called the option's expiration date. And you have that right anytime between when you buy it and when it expires, even if the stock price has gone way above the strike price of your call. Now, a put option is basically the opposite right. A put option gives you the right to sell 100 shares of a stock that you might own at that option strike price before it expires, even if the stock price has dropped way below the strike price of the put. So if you think about it, the ones selling the option to you, they have to be careful not to sell it to you so cheaply, in which case they'd have a very good chance of losing money on that option. Because if they have to sell you shares of a stock way below the market price of that stock, in the case of you owning a call, they will take a bath on that transaction because they'll most likely have to go out into the market, buy the stock at the current higher price, and sell it to you for the lower price, which is the strike price of your call. So the seller of the option is taking that risk, and he will do that at a price where he thinks he's got at least a fighting chance of making money by selling you that option. So he's going to build a cushion into that option for the potential move on the stock, and that's called the options premium. So think about what happens around earnings. As earnings approach, the options market begins to price in the possibility of a big move on a stock, and they price those moves into the price of the options for that stock. So if a stock is coming up for an earnings release, and this is important, any option that expires after the earnings are reported will have a much higher price compared to the options that expire before the earnings release date. And that makes sense. The options that expire before the earnings release date aren't exposed to the potential large moves resulting from an earnings release. But the options that expire after the earnings date will be deeply affected by the price swings coming after earnings. And so the one selling you the option is taking on way more risk than the options that aren't exposed to the earning moves, the ones that expire before the earnings release. So you're probably wondering, how can we make money off of this tendency of options to be pumped up at price if they expire after earnings are over? Well, that's where the double calendar strategy comes in. So let's define what a calendar spread is first, and this will be a little easier for you to understand. Okay, so when you buy a calendar spread, you're basically selling an option during one time period and buying an option at that same strike price in a later time period. Options in later time periods are always more expensive than options in earlier time periods at the same strike price, because the longer out you are into the future, the longer the seller of the option has for the option he sold to create trouble for him, because the market has a longer time to make a big move against the seller of the option. So he has to charge more premium for that additional risk. Now, a double calendar is simply buying a calendar spread at two different prices, one above the trading price of the stock and one below the trading price of the stock. So let's take a look at an example that will put all of this into focus for you. CRM, which is the ticker symbol for Salesforce.com, announced that it was going to release its earnings on June 4th. So on May 3rd, around noon, the stock was trading at around 163. Now, this stock has options which expire right before the earnings release date on May 31st, and options that expire right after the earnings date on June 7th. So the ones that will expire before the earnings are released, the May 31 options, are not exposed to the earnings report volatility. So those are going to have a much cheaper price than the ones just a week later that will be exposed to that earnings release volatility. So let's take a look at the price of the calls about 10 points higher than the stock is trading. The 172.5 strike calls expiring May 31st. So you can see they're at a price of 94 cents. That same strike just a week later on June 7th is going for $2.52, almost 3 times as expensive. Why? Because the market, even a month earlier, is already beginning to price in the move that will happen after earnings. If the stock jumps in price after a good earnings report, the ones selling those June 7th calls are at much more risk than the sort of normal market moves that would take place before earnings are released on May 31st. But it's pretty far from the earnings date, so the market hasn't fully priced in the risk of a big move quite yet on those June 7th calls. Although, as you can see by the pricing of the same strike calls after expiration, that process has started. Now, let's move down to the puts about 10 points below the stock price. Those are the 152.5 puts. The May 31st puts are priced at $1.24, while the June 7th 152.5 puts are priced at about double that, $2.58. So the same logic applies to the downside. The ones selling the puts at 152.5 are exposed to the stock going much lower after earnings because of a bad earnings report. But the May 31st puts expire before earnings, so the earnings-related move is pretty much not a factor as to those options. So what we did here is we've sold the calls and the puts we just discussed at the 172.5 and 152.5 strike prices for the May 31 expiration before the earnings date, and we bought the calls at 172.5 and 152.5 for the options that expire after earnings on June 7th. Now, remember, calls and puts are in 100 share increments. So when we buy an option for $2.50, like the June 7th 172.5 call, we're actually paying 100 times that, or $252. So if we walk through the cost of all this, we pay $252 for the June 7th call, and we kind of subsidize that by selling the same strike May 31st call for $94. So we paid a net of $252 minus the $94 we got for the calls we sold, for a net price of $158. On the put side, we do the same basic thing. We buy the June 7th 152.5 puts for $258, and we sell the same strike puts on the May 31st expiration chain for $124 for a net price of $134. So the total we shelled out for the trade is actually $292 for each lot. We did 10 lots here, so the total price is actually $2,920. That's our risk on this double calendar spread, $2,920. So now let's fast forward to May 31st, the day the options expire, and carefully examine what happened here. As you can see, the stock sold off from May 3rd when we first put the trade on until the day the short options expire, which is May 31st. It dropped to 152.59 at 2:15 in the afternoon, a little less than 2 hours before they expire, and pretty much right at the bottom calendar spread, the put calendar at 152.5. So you can see that the call options at 172.5, both are almost worthless because now the market is 20 points away from those. But the put side, that got interesting. The May 31 put that will expire in about 2 hours has a little value, 37 cents. And even though the market's really close to that strike, there are only 2 hours left for them to go in the money and have any value at all. So even those have shrunk in value, which is good for us because we're short those. But take a look at the 152.5 June 7th put. Even though that's not even in the money, that has blown up in value to $4.74. That's because earnings are in a couple of days and the market is sitting right on top of that strike price. An option like that is worth a lot of money because what if the market tubes after the earnings are released? The seller of that put's going to take a bath because he'll have to buy stock at a price that's potentially much higher than the market's actually trading for that stock because of a lousy earnings report. So that option has gotten valuable for one because the market moved close to its strike price, but much more importantly because earnings are any day now and you just have to charge a lot for the risk of an option at the money right before earnings are going to be released. And so as you can see, if you close the trade now, the total value of the double calendar is now $4,385, which is almost $1,500 greater than the original price of $29.20. That's a return of 50% on our trade in 28 days, yet earnings weren't even announced yet, and we're going to exit the trade. That's the power of the double calendar trade when applied to impending earnings announcements. So what is the major takeaway from this example we showed you today? That there's another way to trade earnings where you're not required to pick a direction and hope the stock runs in the direction that you've picked. Instead, there's a way to basically play the anticipation of earnings that is reflected in the prices of options in the options market and take advantage of that increased value by selling options that expire before the earnings release and buying options that expire after the earnings release. That combination will often yield a tremendous return if you become a skilled practitioner of this trading style. Now, just to remind you, as I said earlier, if you enjoyed this video and would like to learn 3 more real-world option strategies that our traders use, including the surprisingly simple and powerful strategy that some of the greatest investors in the world, like Warren Buffett, use all the time, plus an options trading strategy that has a statistical 80% probability of profit month in and month out, plus an option strategy that you can employ with a stock that you like where you'll make your target profit, whether this stock goes up, goes nowhere, or even goes down a small percentage, then you should check out the free options class that we're currently running. Just go ahead and click the link that should be appearing now at the top right corner of your screen. That will open up the free registration page in a new window and you won't lose this video. It's an extremely rare opportunity for retail traders and investors to learn directly from Wall Street traders, but that's exactly what you'll be getting through this free online workshop. So click the link to sign up now and don't miss it.
Hey, go ahead and click our subscribe button so you don't miss any of the videos that we're producing for you in the trading community. And please take the time to add your feedback in the comments section for what videos you'd like for us to produce next and what you found helpful from this video. From all of us at SMB, train and trade well.